Hello again, this is Professor Graham Jackson from Glyndŵr Business School in Wrexham. Okay, next we will be discussing investment appraisal or capital budgeting as a tool to evaluate different projects. Let's say you decide to open a takeaway business in the food industry. However, you are confronted with a choice between opening curry takeaway or pizza takeaway. Faced with this choice, you need to employ capital budgeting to guide you to make an informed decision, so you make the right decision. There are several tools such as a payback period, accounting rate of return, net present value, internal rates of return and a stability test. We will be discussing briefly payback periods, accounting rates of return and net present value a little later. Okay, payback period is the amount of time required for a project to repay its initial cost, which is a measure of how fast the cash flow has been created and as the project covers the initial cost. As a simple example, if you spend $10,000 opening a small business and the business generates annual revenues of $5,000, this means it will take 2 years to get the payback on the initial cost. A very simple calculation. Accounting rates of return, ARR, is also a tool to evaluate a project's viability. By dividing the income or accounting profits, P, generated by the project, the initial cost incurs are C, or ARR, equals P over C. For example, an investment initially of $200,000 is required to run a small buffet restaurant. The investment is expected to generate an annual cash income of $50,000 for 5 years. Since the average annual return is £50,000, the ARR is PC equals 50,000 over £200,000, multiplied by 100%, which equals 25%. Just write these down. When there are several projects under consideration, the project with the highest ARR is the best one, is the one preferred. Let's look at net present value, NPV, and calculate that. It's a company's revenues, the inflow, and expenses, the outflow, after considering the time value of money, such as the effect of inflation or the cost of interest. When calculating the above payback period and accounting rate of return, all revenues are future valued and need to be discounted by the rate of inflation or a discount factor. To take into account the value of the money, remember that £1,000 received today is not the same as £1,000 received next year. £1,000 received next year may only be worth £980 today, depending on the rate of inflation or the discount factor. Hence, the present value is equal to the future value multiplied by a discount factor. By calculating the present values, a manager will be able to estimate the value of future revenues in today's money terms. In addition, he or she can calculate the opportunity costs of the investments to help decide whether the company would be better off investing their money in another project or elsewhere.